Hello, from three students. Welcome to our business studies lesson. And today we go to a new topic, the one we call national income. And this is our lesson number 1. I'm your teacher, Mr. Wanyoike from Maryhill Girls High School. Welcome. The objectives of this topic are as follows. Number 1 is that you should be able to explain the meaning of national income. 2, describe the circular flow of income. 3, explain the methods of measuring national income. Number 4, explain the problems encountered in measuring national income. Number 5, discuss the uses of national income statistics. And number 6, discuss the factors which influence the level of national income of a given country. Now define the term national income. The term national income refer to the total income received in a country or by the providers or the owners of factors of production in a given country over a given period of time. We can say it is the total amount of income made by a country from economic activities in 1 year time. It is the total amount of income made by a country from economic activities in 1 year time or in a given year. And it is important to note that it includes payments made to all the resources, either in form of wages. Remember, for you to acquire factors of production, you need to pay wages because you have used labor, interest for the capital invested, land rent for the land used, and the investment itself should give profits. And therefore, the progress of a country can be determined by the growth of the national income of the country. And therefore, it is important to note that when we talk about national income, we are talking about the income that has been made by the citizens or by the owners of factors of production. Remember the factors of production? We discussed them in Form 1. They are land, labor, capital, and the entrepreneurship. And they are the ones that generate national income. They generate profits or proceeds. And these proceeds are the ones that constitute national income. And as we talk about national income, we'll be considering all the citizens. What are they producing? How much are they earning? How much profit, how much earnings they have made in one given year. And this is what we call national income. It is from this national income that a country is able to finance its projects as a country. It's able to move on, pay wages, pay salaries, or maybe come up with the development projects such as roads, railway lines, electricity, water, and so on. So we can say, or we can rather say, national income is also can be defined as the money value of all the final goods and services produced in an economy during an accounting period of time, generally 1 year. And these goods and services, they will be in monetary terms. That's why we are talking about what has been produced in a country, be it in terms of wages earned, be it in terms of goods sold. Then the total monetary value of that is what is making national income. And therefore, the work done by all the citizens in a country is put together, and the outcome of that is monetized, and this is what we are calling national income. Let us now discuss concepts of national income. We have terms that we will be discussing or be using when you talk about national income. Like number 1, we'll be talking about gross national product or GDP. Number 2, we'll be talking about gross national product, GNP. We'll also be talking about net domestic product, NDP, and net national product, NNP. And we also talk about per capita income. Maybe in the past you have heard about these terms. Now we'll be looking at them in detail. Let us now look at the terms used in national income. Number 1, we said it is a gross domestic product, GDP. Now, this is the total monetary value of all goods and services produced in a country during a particular year. Such goods and services must have been produced within the country. Within the country. So it is not production outside the country. It is within the boundaries of a given country. That's why we're using the word domestic, meaning within. Number 2 is net domestic product. Net domestic product, or NDP. This is the GDP, or gross domestic product, when we subtract depreciation. Now, depreciation is a loss in value of assets as a result of being used in the process of production. For example, if we use machinery, it is wearing out. If we use our roads, they are wearing out. How much have we lost in the process of earning what we have earned? So we need to less that, and we can put it in bracket as expenses, or what we have spent in the process of earning whatever amount we have earned. So when we talk about net domestic product, we'll be talking about gross domestic product minus depreciation. And this depreciation, we said, is the loss in value of the assets we have used in the process of earning whatever we have earned in a given period of an year. Number 3, we have gross national product. Gross national product, GNP. This concept measures the total monetary value of all the goods and services produced by the people of a country, regardless of whether they produced those goods and services when they were inside the country or outside in other countries. So we are looking at the citizens. Where are they? Are they outside the country or inside the country? We put all the income together of those outside the country and the production of those inside the country. And it takes into account the exports and the imports, what you have exported and what you have imported. The difference between the export and the import, which is called net factor income from abroad, is it increases the gross national product. For instance, if it is Kenya, if we exported more goods than we imported, it means we earned more. Because when you import goods, you pay for those goods. When you export goods, you are selling and you are getting money. And therefore, the difference between what you have earned from your exports minus what you have spent on your imports, that is what we are calling net factor income. Net factor income from abroad. Plus, now, what citizens have earned or made in terms of income, whether they were outside the country or inside the country. So that put together is what we are calling gross national product. So we are looking at 3 components. Number 1, what the local citizens or citizens within the country have made in terms of an income. Number 2, what the citizens outside the country have made outside the country. So those citizens, if they belong to Kenya, they are earning money outside there, they are employed. How much have they earned? They are doing business. How much have they made? So all that belong to Kenyans. That's why you're looking at the gross national product as that which has been made within the country and that which has been made outside the country. Now, plus the net factor income. Exports minus imports. What you have earned from your export minus what you have spent on your import. So that put together gives us the gross national product. And therefore, it is a sum of maybe the gross domestic product plus the net factor income from abroad. Factor number 4, or item number 4, it is net national product. Net national product, NNP. Now this one is on top of the gross national product, and it recognizes the loss in value of capital in the process of production. Remember, we also have depreciation when we are preparing our exports, when our people are going out to earn, when they are using their equipment to produce goods for export. Those machines they are wearing out, the equipment used are wearing out, and therefore net national product is gross national product minus depreciation. So that gives us the net national product. Item number 5 or term number 5 is per capita income. Per capita income. Now, once we get the net national product, we need to know on average, if we divide by the number of people in a country, on average, how much was made by each citizen. Maybe you say like each Kenyan, how much did they earn in the year 2019? For us to do that, we'll get net national product, we divide by the number of people in a country. And therefore, per capita income is the average income per head per year in a given country. It is the national income divided by the population of the country. And this national income, we have said it is the net national product. Now, it means that when there is national income, it means there is flow of income from the buyers to the sellers. And this flow is what we call the circular flow of income in an economy. So let us now discuss the circular flow of income in an economy. Number one, we say that the circular flow of economy is that this is the continuous movement of income between the households or the providers or factors of production and the farms or the producers of goods and services. We have said this is the continuous movement of income between the households and this is between the providers or factors of production, because the households are the owners of the factors of production. Why do we say this? It is people or citizens who own land, which is a factor of production. They also own labor as a factor of production. And this is what farms need in order to produce, in order to become productive. And for the farms, they are the one who now put the factors of production together, namely land, labor, capital, and entrepreneurship. They put them together in order to produce goods and services. And we have said these factors of production are obtained or they are owned by households. Even the owners of those farms, they are the entrepreneurs and they belong to the households. And therefore, the farms have to buy or to pay for these factors of production from the households. In other words, you can say the circular flow of income or circular flow is a model of the economy in which the major exchanges or are represented as flows of money, goods and services between economic agents. And the economic agents here are the sellers or the consumers, the ones we have called households, and the buyers and or the producers, which are the farms. So in this case, we'll have two parties, the households and the farms. The households and the farms. Let us look at flow of income in a two-sector economy. Flow of income in a two-sector economy. Remember, this hypothetical or flow, and it is assumed that there are two players in a flow of income, or the way the wealth flows from the citizens to the country, or from between the consumers and the producers. How does the wealth flow? So here it is assumed there are only two players, the households and the farms. And the farms are the ones that are making goods. And for them to make goods, they need factors of production from the households. So it is a cycle where the wealth is flowing. So farms buy factors of production from citizens or households. Now households now have money. This money, they buy the finished products from the farms. And that's why we are talking about a cycle or a flow. So the farm, the factors of production are received from the households. That's what you have said that. Then the farm pays for the rewards or buys the factors of production from the households. And this is an expenditure to the farm and income to the household. So the farms will spend money and the households will receive that money because the households have given factors of production such as land, such as labor, such as capital, such as entrepreneurship, and then the farm will pay for those factors, will give rewards, or will reward those factors of production as we discussed in Form 1. Then after that, the households in turn will use that income to buy the goods and services produced by the farms, and therefore they are going to spend that money, or it is an expenditure to the households and is an income now to the farms, and that's how the flow goes on. So the money keep on flowing, as shown in the next slide. So in this diagram, it is representing the flow of income in a simple economy or in a two-sector economy. And there are two players, the households, or the one in blue, and the farms also in blue. And we can see the flow of goods and factors of production. They are also in blue. So the households will supply the farms with land, labor, capital, and also the entrepreneurs will come from the households. So we have the factors of production. You can see the arrows are flowing from the households to the farms. And then the farms in return will pay for these factors of production in form of rent, wages, profit, and interest for the entrepreneur, which is an income. And therefore, the money will flow from the farms to the households. You can follow the flow or the chain in red on your left. Then on your right, still inside the loop, we have flow of goods and services from the farms. Remember, now the farms have acquired the factors of production. Now they have started producing goods, and we have the finished products such as bread, clothes, and so on. And therefore, the goods now will move from the farm to the household. You can see on your right where you have the blue arrow moving from farms to the households, and that one is representing the flow of goods and services. Now, in return, the households will have to pay for these goods and services, and therefore money again now will have to flow from households, and it will go to the farms. And the household that time, it will be spending money, or is an expenditure on goods and services, and that's what we call a two-sector economy, circular flow of income. This kind of analysis of how wealth flows from household to the farms, and then from the farms to the household, such that the wealth keep on rotating, or in a cycle, from household to farms, from farms to household, from household to farms, and so on. It takes some assumptions for it to work, or for it to hold. So let's discuss assumptions or features of circular flow of income in a two-sector economy. Number one, it assumes that there is existence of two sectors only. It assumes that the economy has two players, the households and the farms, and the households provide factors of production, while the farms are involved in production of goods and services, and there is exchange of money between the two. Assumption number two is that all the money earned by the household is spent on buying all the goods and services produced by the farms, and therefore no money is saved, because all the income by the household is used to buy what is produced by the farms. The next assumption is that the total spending by the farms, there is total spending by the farms. It assumes that the farms do not save any money they make from their production, and therefore they spend all the money in paying for the rewards of rewarding the factors of production. So they spend all the money paying labor, all the money paying for land, all the money paying the entrepreneur, and so on. And therefore, there is no money that is saved. So, which is may not be very true, but the assumption is that if you have a two-sector economy, then all the money made by the farms will be spent on paying the factors of production, and all the money earned by the households will be spent on buying what the farms are producing. Feature number 4, or assumption number 4, is that there is no government intervention. It assumes that farms do not pay taxes, Even citizens do not pay taxes. There are no price controls such that it is the household who decide how much they are going to sell their factors of production, and it's the farms that decide at what price they are going to sell their products, and therefore it assumes there is no government intervention. And number 5, it is a closed economy. It assumes goods produced by the farms are never exported, and households do not import goods. They don't import clothes, they don't import drugs and so on. So they rely on what is made by the farms within their country. So these are just a hypothetical system, and it is good for a start that we know how the wealth of a country flows from between the farms and the households, and also the assumptions thereof. Now in the next slide, we'll do a summary. Students, I want you to be very keen on the summary of a two-sector model of flow of income. Note that anytime they are told to draw this kind of circular flow of income, flow of money is on the outer loop. That's why we have income in the form of wages, interest, and rent going to the households. And then we have also income flowing or from the households to the farms, meaning they are spending money. So on the outer loop, we have expenditures or money flowing there. On the inner loop, which is in red, we have flow of goods. Goods flowing from households to the farm in terms of factors of production, that is land, labor, and enterprise or entrepreneur. And we also have goods and services that have been manufactured by the farms, flowing from the farms to the households. Note the flow of money or the flow of income is in black, and on the outer loop, flow of resources or goods and services is in the inner loop, and it is in red. Students, we have come to the end of our lesson today. I hope you have learned a lot. Replay the video to learn all the concepts taught in this lesson and to ensure that you have understood every concept in this lesson. Have a good day.
Feel the love he felt for us when he bore our sins. Listen to his words, let them come alive. If we know him as he is, there is peace in Christ. He gives us hope when hope is gone. He gives us strength shelter in the storms of life. When there's no peace on earth, there is peace in Christ.